It is a common misconception among the public that the greatest losses in the stock market arise from selecting the wrong securities. This is a fallacy. Richard Wyckoff, through decades of observation from his unique vantage point within the inner workings of Wall Street, concluded that more money is lost through the poor management of trades than through faulty selection. Specifically, the majority of financial ruin can be traced to the misuse or non-use of one critical tool, the stop-loss order. This instrument, when understood correctly, is not merely a defensive tactic, it is the very foundation of a professional trading career. It is the mechanism that separates speculation from blind gambling. In this analysis, we will dissect the 5 fatal errors in the application of the stop order, errors that Wyckoff identified as the primary causes of failure for the aspiring trader and investor. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. The first and most catastrophic error is a sin not of technique but of character. It is the failure to employ a stop-loss at all. This decision is rooted in the most destructive emotion a trader can entertain, hope. When a position moves against him, the amateur trader does not see a business loss to be managed. He sees a temporary setback that he hopes will reverse. He clings to the belief that the market must surely recognize its error and restore his position to profitability. He watches his equity dwindle, paralyzed by the hope of a comeback. Wyckoff regarded this as nothing less than financial suicide. To trade without a stop is to reject the fundamental premise of treating speculation as a business. A business owner accounts for costs, manages inventory, and plans for contingencies. He does not simply hope that expenses will disappear. Wyckoff offered a powerful analogy. He compared the stop-loss order to fire insurance on a house. No prudent man would own a property without insuring it against a catastrophic fire. He pays a small known premium to protect himself from a large, unpredictable, and potentially ruinous loss. The stop order is precisely this, a small, predetermined premium paid to protect one's capital from the fire of an adverse market move. The trader who refuses to place a stop is like the homeowner who cancels his insurance because he does not expect a fire today. He may be right for a day, a week, or a month. But eventually the unexpected will occur, and when it does, the loss will be absolute. The historical record of the markets is littered with the wreckage of accounts managed by hope. In his own writings, Wyckoff detailed the cautionary tale of Union Pacific. He observed traders buying the stock around $160, watching it climb to $164, and feeling secure in their paper profit. Then the trend shifted. The stock began to decline. At $155, the trader, still anchored to the recent high, sees it as a bargain and buys more. At $150, his conviction deepens and he averages down again, loading up on what he perceives to be an even greater opportunity. He is no longer analyzing the tape, he is arguing with it, fueled by the hope that his initial judgment must be vindicated. But the tape is always right. The decline continues to $145, then to $140. His broker calls for more margin. He is now so heavily committed, his judgment so clouded by his escalating loss, that he is forced to meet the margin call, throwing good money after bad. Finally, the stock falls to a point where his capital is exhausted, and the broker is forced to sell him out at the worst possible price, crystallizing a catastrophic loss. All of this could have been averted by a single, simple decision made at the outset. The placement of a stop order at a logical point below his initial entry, turning a ruinous event into a calculated, manageable business expense. The second fatal error is the sin of guesswork, using an arbitrary stop-loss. This is an attempt to apply a mechanical, one-size-fits-all rule to a fluid and dynamic environment. The trader, seeking simplicity, will decide to place his stop at a fixed 2% below his entry, or perhaps a predetermined 3 points away. This approach is seductive because it requires no thought. It is a simple calculation. However, it is fundamentally illogical. The market has no knowledge of and no respect for a trader's arbitrary 2% rule. The true function of a stop loss is not simply to limit a loss to a certain dollar amount. Its purpose is to signal that the original thesis for entering the trade has been proven incorrect. Therefore, the placement of the stop must be determined by the structure of the market itself. Wyckoff insisted that a stop must be placed at what he called a logical danger point. This danger point is a price level that, if breached, invalidates the reason for the trade. It is based entirely on the chart's landscape of supply and demand. To determine the correct placement, one must first identify the governing structure. For a long position, the trade is typically initiated on the belief that demand is overcoming supply at a certain price level, establishing a foundation for a future advance. This foundation is known as support. The logical danger point, therefore, is just below that level of support. If the market breaks below this critical threshold, the initial analysis is invalidated, the premise of dominant demand is proven false, and there is no longer any logical reason to remain in the position. Let us consider a few practical examples from the Wyckoffian perspective. A trader identifies a spring, a sharp thrust below a prior support level that quickly reverses, trapping weak-handed shorts and indicating that large interests are accumulating shares. He decides to go long. Where should the stop be placed? An arbitrary 3 points below his entry is meaningless. The logical placement is just below the low of the spring itself. Why? Because the entire premise of the trade is that the market tested for supply below the support level and found none, hence the sharp reversal. If the price were to fall below the low of that spring, it would negate the entire signal. It would indicate that supply is, in fact, still present and in control, and the trader should immediately exit the position. Similarly, after an advance, the market may have a natural reaction or pullback. A trader might enter on the assumption that this pullback is complete, and the uptrend is resuming. The logical place for his stop would be just below the low of that pullback. A break of that low would signal that the correction is deeper than anticipated, and the uptrend may be in jeopardy. In the case of a short sale following an upthrust, a failed rally above resistance, the stop must be placed logically just above the high of that upthrust. A move above that peak would prove that the buying pressure is stronger than initially judged. In every case, the stop is not a guess. It is a direct response to the market's own story as told by the tape. We now transition from the errors made when initiating a trade to the critical mistakes made in managing an open position. The third fatal error is the sin of ego, moving a stop loss to increase risk. Once a logical stop is in place based on the market's structure, the trader's work is to let the market prove him right or wrong. However, when the price moves against him and approaches his stop, a battle begins in his mind. His ego does not wish to admit a mistake. As the price nears his exit point, he convinces himself that it is just a temporary shakeout and that moving the stop just a little further down will give the trade the room it needs. He cancels the original order and places a new one further away from the current price, thereby increasing his potential loss. This is a cardinal sin in trading. Wyckoff was unequivocal on this point. A stop-loss order can be moved in one direction, and one direction only, in the direction of the trade, to reduce risk and protect profits. To move it in the opposite direction is to tear up your fire insurance policy while the flames are licking at your door. This single action corrupts the entire foundation of sound speculative practice. The initial stop represented a planned, quantified risk, a business expense. By moving it further away, the trader transforms that calculated expense into an unknown, emotional, and potentially unlimited liability. He is no longer trading based on a plan. He is gambling based on hope and ego. He has begun to argue with the tape, a debate no trader has ever won. The consequences are devastating, not only financially but psychologically. It destroys discipline. It replaces a sound method with emotional decision-making. A small loss, which should have been taken cleanly and professionally, is allowed to metastasize into a large damaging blow to both capital and confidence, making it that much harder to take the next trade with a clear and objective mind. The fourth fatal error is the inverse of the third, and it springs from an opposing emotion. It is the sin of fear, placing a stop-loss too close to the entry point. The trader, having perhaps suffered from large losses in the past, becomes excessively risk-averse. He is so terrified of losing money that he places his stop within the bounds of the market's normal random fluctuations, what Wyckoff would identify as market noise. This action paradoxically almost guarantees a loss. The market does not move in a straight line. Even in the strongest of trends, there are constant minor oscillations, reactions, and shakeouts. These are the natural breathing motions of the market. By placing a stop too close, the trader ensures that one of these meaningless wiggles will trigger his exit, knocking him out of a perfectly sound position just before it makes its intended move. This is precisely the outcome that large composite operators aim to produce. They understand the psychology of the public and know that fearful traders will place their stops in obvious, tight clusters. They can then engineer a quick, sharp move, a shakeout, to trigger these stops, allowing them to absorb shares at a favorable price before initiating the real advance. The trader who places his stop too close is not reducing his risk. He is merely paying the composite operator for his education. The correct approach, as Wyckoff taught, is to place the stop at a logical point that is outside the expected range of this random noise. It must be placed just beyond the true support or resistance level, giving the trade sufficient room to breathe and to withstand the inevitable minor fluctuations that have no bearing on the larger trend. This requires judgment and an understanding of the stock's typical volatility, but it is essential for surviving the engineered shakeouts and remaining in a position long enough for it to bear fruit. Wyckoff's method of deducing future market moves from the past and present action of the tape was his primary method of forecasting. He was one of the titans of his era in this field. It is worth noting that another legendary figure of the same period, William Gann, developed his own unique and profoundly different methods for forecasting market turns. While Wyckoff focused on the internal market dynamics of supply and demand, Gann incorporated the study of geometry, natural law, and time cycles to project future market movements with astonishing accuracy. For those who are fascinated by the science of market forecasting and wish to explore these complementary yet distinct approaches, you are invited to visit our new sister channel, William Gann Trading Insights, for a deep dive into his remarkable methodologies. This brings us to the final and perhaps most sophisticated error. The first four mistakes were defensive in nature, concerned with the avoidance of ruin. This fifth error is offensive. It relates to the failure to maximize opportunity. It is the sin of greed and impatience, improperly trailing a stop to secure profits. The amateur, when he is fortunate enough to have a winning trade, is beset by two conflicting emotions. The first is impatience, a form of greed for a quick victory. He sees a small profit and rushes to take it, fearing that it will evaporate. The second is pure greed. He sees a larger profit accumulate and becomes mesmerized by it, failing to protect it, and ultimately allows the market to take it all back. Both outcomes are failures of management. Wyckoff was clear that the largest profits come from correctly identifying a major trend and having the discipline to follow it. The tool for accomplishing this is the trailing stop. The trailing stop is the professional's method for letting profits run while systematically eliminating risk. It is a dynamic process that adjusts to the market's progress. The technique, when applied correctly, is both simple and profoundly effective. Imagine a stock is in a clear uptrend. It makes a strong upward move, then experiences a natural reaction or pullback on lighter volume, forming a higher low. Once the stock resumes its advance and moves to a new high, the professional trader moves his stop-loss order up to a point just below the low of that last completed reaction. He has now locked in a portion of his profit and has reduced his risk. As the trend continues, making another new high and completing another pullback, he once again trails his stop up to just below the new higher low. He repeats this process systematically. His exit is not determined by fear, greed, or a predetermined price target. His exit is determined by the market itself. He will only be stopped out when the stock's uptrending character finally changes. That is, when it violates the prior reaction low, signaling that the trend is either pausing or reversing. This methodical approach takes the emotion and guesswork out of exiting a winning trade. It allows the trader to capture the majority of a major move, which is the entire purpose of speculation. We have just dissected the 5 fatal mistakes that lead to financial ruin. But what is the antidote? The principles of sound speculation, risk management, and the construction of long-term capital are the cure, and they are laid out in detail in Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of this work by Max Davidson. It has been meticulously adapted for the modern trader, with complete explanations that make Wyckoff's timeless wisdom more accessible than ever. If this video is a diagnosis of the disease, then this book is the prescription for a long and healthy trading career. The link to this book is located in the description of this video. In summary, we have examined 5 fundamental errors: trading without a stop, the sin of hope; using an arbitrary stop, the sin of guesswork; moving a stop to increase risk, the sin of ego; placing a stop too close, the sin of fear; and failing to trail a stop correctly, the sin of greed and impatience. Mastering the proper use of the stop loss is not about the avoidance of losses. Losses are an inevitable and necessary part of the trading business. Mastery is about the control of losses. It is about ensuring that they are always small, calculated, and logically determined. This singular skill, more than any other, is the defining characteristic that separates the professional who builds a career from the amateur who inevitably becomes another casualty of the market.